Larry, in your new book, on page 50 specifically, there is a chart showing the impact of the Fed stimulus on the S&P 500. For listeners, there's a direct, undisputable correlation in this chart between the S&P 500 and the Fed's balance sheet going back to 2008. Larry, given everything that we just spoke about, and with both political parties fully committed to more and more debt, do valuations even matter anymore for equities?
Okay, so right now we're trading at 22 times forward earnings, which is one of the most extreme, one of the most extreme levels in terms of forward earnings. So that's in terms of what earnings are supposed to be next year, and so we're priced for perfection. And not only that, but the risk-free rate relative to equities points toward everything, every model, everything I can tell you. We're coming into another lost decade for stocks, because historically, whenever we're this stretched, where bonds are getting more and more competitive to stocks, you go through a period of time. We've had, in the last 60 years, I think we've had 2 or 3 10-year periods where equities were flat. Now, where equities have done well, like you said, is when the Fed's, doing quantitative easing, or this past year, in some ways, we're doing kind of stealth quantitative easing, because the Fed was, the Treasury was issuing so many T-bills, and there's a lot of games being played behind the scenes. So there's a lot of things they did to get, they just want to get us through the election. But next year, and as inflation bounces, it forces us into an entirely different playbook. So yeah, the probability that we go, say 5 to 10 years with equities flat from here is very, very high.